Act 1 Mental Reset. Welcome. Make yourself comfortable. Take a deep breath. This is a journey toward a real understanding of trading, not toward an illusion. Let go of everything you think you know. Let go of expectations. Let go of the rush. Let's start from the beginning. From the true beginning. The market is uncertainty. Repeat it with me, mentally. The market is uncertainty. It is not an enemy to be defeated. It is not a riddle to be solved. It is simply uncertainty. And this is not a weakness of the market. It is its fundamental nature. Think of the market as an ocean. You can predict there will be waves, but you cannot say exactly when the next wave will arrive, how high it will be, or where it will take you. You can only learn to navigate, and navigating does not mean controlling the ocean. It means respecting it. The market is probabilistic. This is a truth you must fully absorb. Certainties do not exist. There are only possible scenarios, each with its own probability. When you open a trade, you aren't saying, "I know what will happen." You are saying, "I have assessed the probabilities, and this action makes sense in the long run." Breathe. Let this concept settle in your mind. Every trade you make is just one event in a long series. A single trade does not define you as a trader. It doesn't define your system. It doesn't define your future. It is just a data point in a larger statistical sample. Like a coin toss. If you toss a coin and it comes up heads, it doesn't mean the coin is rigged. If it comes up tails 3 times in a row, it doesn't mean it will definitely be heads next time. Repeat mentally. I do not seek certainties. I manage probabilities. Let this phrase become part of you. I do not seek certainties. I manage probabilities. It is a fundamental distinction. Those who seek certainties in trading are destined for frustration because they seek them where they do not exist. Those who manage probabilities instead build a sustainable approach. A single trade means nothing. Repeat it. A single trade means nothing. It can be an extraordinary winner or a painful loss, but in the big picture of your trading career, it is simply a drop in the ocean. What matters is the series. What matters is consistency over time. Imagine you are a scientist conducting an experiment. You don't draw conclusions after a single test. You collect data, 100 tests, 1,000 tests, and then you analyze the overall results. Trading works the same way. Breathe again, deeply. Now, let's talk about a crucial distinction. Trading is not the same as a casino. This is a false equation many people make. At a casino, you gamble. The house has a statistical edge over you, always. Every time you play, mathematically, you are destined to lose in the long run. There is no choice, no control, no strategy that holds up. Trading is different. In trading, you don't gamble. You manage risk and statistics. You build a system that has a positive statistical edge over time. You decide how much to risk on every trade. You choose when to enter and when to exit. You have control over your actions, even if you don't have control over the outcome. This distinction is everything. At a casino, the more you play, the more you lose. In trading, if you have a valid system and you follow it, The more trades you make, the closer you get to your statistical advantage. But be careful, and listen closely to this part. The price is stronger than you, always, no matter how large your capital is, no matter how smart you are, no matter how much you have studied. The market is bigger, stronger, more powerful. You cannot bend it to your will. Repeat, I do not control the market. I only control my actions. This is a liberation, not a limitation. When you accept that you don't control the market, you stop fighting against something impossible. You focus your energy on what you can actually control: your discipline, your risk, your rules, your emotions, your decisions. The market will do whatever it wants. You can only decide how to respond. Breathe again. Feel the weight of these words lightening within you. Now we must talk about expectations. Unrealistic expectations are the #1 killer of new traders. They are the poison that destroys accounts and self-confidence. We must reduce them. We must bring them back to reality. No fast gains. This is the first illusion to abandon. Trading is not a way to get rich quickly. It is not a lottery ticket. It is not a shortcut. Anyone who tells you otherwise is lying or trying to sell you something. Successful traders build their skills over years, not days. They accumulate experience trade after trade, mistake after mistake, lesson after lesson. Their capital grows slowly and steadily, not in spectacular explosions. If you come to trading looking to double your account in a month, you are already losing. You are setting expectations that will lead you to take excessive risks, ignore your rules, and chase the market instead of waiting for your opportunities. Breathe. Let go of the rush. No strokes of luck. Trading is not based on luck. Sure, a single trade can be lucky or unlucky, but a trading career is not built on luck. It is built on repeated competence over time. When you see someone who made an exceptional trade, remember, you are not seeing the 100 trades they made before, nor the 100 they will make after. You are seeing an isolated moment. You cannot build a strategy on luck, because luck, by definition, is not repeatable. Your goal is not to be lucky. Your goal is to be consistently competent. No comparison with others. This is perhaps the hardest one to accept. We live in a world of social media where everyone only shows their successes. You will see screenshots of huge profits. You will see people who seem to trade as if it were simple. Do not compare yourself to them. You don't know what is behind those screenshots. You don't know how many losses they had before. You don't know if those profits are real or simulated. You don't know if those people will still be in the market a year from now. And above all, their path is not your path. Their account is not your account. Their decisions are not your decisions. Repeat. My only metric is improving compared to yesterday. This is your true benchmark. Not the famous trader on Instagram. Not your friend who says they made a perfect trade. You today compared to you yesterday. Did you follow your rules better? Did you manage your emotions better? Did you learn something new? Did you avoid a mistake you used to make This is progress. This is real success. Trading is a personal journey, not a competition. You only compete with the version of yourself from yesterday. Every day the goal is to be a slightly better trader. Not perfect, not the best in the world, just better than yesterday. Take a deep breath. Feel these truths settling into your subconscious. The market is uncertainty, and that is okay. You don't seek certainties. You manage probabilities. A single trade means nothing in the grand scheme. You aren't gambling. You are managing risk and statistics. You don't control the market. You only control your actions. You don't seek fast gains. You build competence over time. You don't chase luck. You build consistency. You don't compare yourself to others. You improve compared to yesterday. These are the pillars of your mental reset. This is the foundation upon which you will build everything else. Without this foundation, any strategy will crumble. With this foundation, even in difficult moments, you will remain solid. Let these concepts flow through your mind as you relax. You don't have to consciously memorize them. Let your subconscious absorb them naturally, like a sponge absorbs water. The market is probabilistic. You manage probabilities. A single trade means nothing. I do not seek certainties. I manage probabilities. I do not control the market. I only control my actions. My only metric is improving compared to yesterday. Repeat these phrases in your mind, gently, without effort. Let them become part of your way of thinking. This is your new beginning. This is your mental reset. You have dismantled the illusions. Now you are ready to build something solid, something real, something that will last over time. Breathe, relax, absorb. The first step is complete. Act 2, Survival. Take a deep breath. Now that you have completed the mental reset, let's talk about survival. Because in trading, before thinking about earning, you must learn how not to lose everything. First protect, then earn. This is the correct order, and it cannot be reversed. Most new traders come to the market thinking about profits. They dream of percentage gains. Imagine winning trades and calculate how much they could make in a month. But they are looking at it from the wrong side. Professional traders think about protection first, risk first, survival first. Because they know a fundamental truth. If you protect your capital, you will always have another opportunity. If you don't protect it, the game is over. Let's talk about risk management. This is the first thing to learn. Not entry strategies, not indicators, not patterns. Risk management. The management of risk. It is the base of everything, the foundation on which every other skill rests. Listen carefully. Risk must be defined before entering the trade, not after, not during, before. Even before clicking the buy or sell button, you must know exactly how much you are willing to risk on that specific trade. This is discipline. This is professionalism. Imagine a firefighter entering a burning building without having planned the exit route. It would be madness. In trading, it's the same. Entering a trade without knowing where to exit if things go wrong is pure madness. Risk must be a fixed percentage of your capital, not a random amount. Not how much I feel like risking today. A fixed percentage decided beforehand that you always respect. 1, 2, at most 3% per trade. Never more. Why a fixed percentage? Because it protects you from yourself. In moments of euphoria, when you've just had 3 winning trades in a row, you will want to risk more. The fixed percentage tells you no. In moments of frustration, when you've just had 2 losses, you will want to make it back with a larger trade. The fixed percentage tells you no. The fixed percentage is your guardian. It is the voice of reason when emotions are screaming. Breathe. Let this concept settle. The size of your trade, the quantity you buy or sell, is not decided randomly. You calculate it mathematically from your stop loss. This is crucial. You work backward compared to what most people do. Normal people decide, I'll buy 10 shares, or I'll open a contract. Then they place a stop somewhere and hope it goes well. You do the opposite. First, you identify where the stop loss must be for technical reasons. Then, you calculate how many shares or contracts you can afford to buy, so that you respect your fixed risk percentage if that stop is hit. Simple example. Your account has 10,000 euros. You risk 2% per trade, so 200 euros. Your technical stop is 2 euros away from your entry point. How much can you buy? 200 divided by 2 equals 100 shares. Not one more, not one less. Mathematics decides for you, not emotion, not hope, not greed. Mathematics. Repeat mentally. First, I protect the account. Then I think about profits. This phrase must become your daily mantra. Every morning, before looking at the charts, repeat it. First, I protect the account. Then I think about profits. Because without an account to protect, there will be no profits to think about. It's like a Formula One driver. First, they learn how not to crash. Then, they learn how to go fast. The order is important. If you try to go fast before learning how to control the car, you crash. And when you crash in trading, it means burning your capital. Protection first. Always. Take a deep breath. Now let's talk about the stop loss. The stop loss is not an enemy. It is not something negative. It is not an admission of defeat. The stop loss is security. It is your safety net. It is the difference between a controlled loss and a catastrophe. The stop loss must be technical. What does technical mean? It means you don't place it based on how much you want to lose. You place it based on where the market tells you your idea is wrong. Every trade is based on an idea. I think the price will rise from this support. I believe this resistance will be broken. The market will confirm or deny this. The stop loss should be placed at the point where, if the price reaches it, your analysis is clearly invalidated. It is not about, I feel comfortable losing 100 euros. It is about, if the price falls below this technical level, my analysis is wrong and I must get out. This is the difference between an emotional trader and a technical trader. The emotional one uses random stops. The technical one uses logical stops. And listen closely to this part, because it is where most traders fail. Never move the stop loss. Never. If you set it at a certain level for technical reasons, it stays there. You don't move it further away because the price is about to come back up. You don't move it just this once. You make no exceptions. Never. Because when you move the stop, you are destroying the mathematics of your system. You are telling the market, my rules mean nothing. I am willing to lose more because I hope things will change. And the market is ruthless with those who hope instead of planning. Moving the stop turns a small, controlled loss into a large, devastating loss. It destroys accounts. It destroys careers. It destroys confidence. The stop loss is an integral part of your strategy. It is not optional. It is not something you add if you remember. It is as essential as the entry itself. In fact, it is more important than the entry. Repeat, the stop is part of the plan. I do not negotiate it. Breathe these words. The stop is part of the plan. I do not negotiate it. Make them yours. When you are in the middle of a trade that is going against you, when you see the price approaching your stop, this phrase must resonate in your mind. You do not negotiate. You do not hope. You do not beg the market to turn back in your favor. You respect the plan. Imagine a surgeon in an operating room. They have a protocol. If a certain complication arises, they have a defined procedure. They don't improvise. They don't hope the complication resolves itself. They follow the protocol, because the protocol was designed in a moment of lucidity, not in the panic of the moment. Your stop loss is your protocol. It was decided when you were lucid, before entering the trade, when emotions were not clouding your judgment. When the trade goes wrong, trust that moment of lucidity. Now we come to a concept that will completely change your relationship with losses. Healthy losses exist. Yes, you heard that right. There are losses that are disguised victories. A loss with rules is a success. This phrase seems counterintuitive, but it is profoundly true. If you enter a trade perfectly following your rules, if you manage risk correctly, if you place the stop in the right place, and then the trade results in a loss, you have not failed. You have succeeded in the process. The outcome of a single trade does not define success. Remember, a single trade means nothing. What matters is the quality of the process. And if you followed an excellent process and the trade lost, you still won where it counts. In discipline, in professionalism, in execution. The market is probabilistic. Even with a system that wins 60% of the time, you will lose 4 trades out of 10. Those 4 losses are not failures if you followed the rules. They are a natural part of the statistical distribution. The mistake is not the loss. The mistake is violating the plan. This is the distinction that separates successful traders from failures. Failing traders judge themselves based on the result. Profit equals good, loss equals bad. Successful traders judge themselves based on the process. Rules followed equals good, rules violated equals bad. You could make a trade that violates all your rules and still make money. The trade is a mistake, even if it was profitable. You are reinforcing the wrong behaviors. Next time you might do the same and lose everything. You can make a perfect trade that respects every single rule and lose. That trade is a success, even if it resulted in a loss. You are reinforcing the right behaviors. In the long run, these behaviors will build your success. Repeat. I accept the loss when I have followed the rules. Take a deep breath. I accept the loss when I have followed the rules. This acceptance is liberating. It frees you from the paralyzing fear of losing. It allows you to see losses for what they are. Feedback from the market, not judgments on your worth. When you have followed the rules, you can close a losing trade with your head held high. You did your job. The market decided differently this time, but you did the right thing. And by repeatedly doing the right thing, the results will come. Think of a professional poker player. They fold one hand, fold another, and fold yet another. They aren't losing. They are managing probabilities. They are waiting for the right moment. They accept small losses, the blinds, the antes, as part of the game. You are the same. You accept controlled losses as part of the game. They are the cost of doing business. They are the price to pay for the opportunities you will capture. But beware. This acceptance only works if you have a valid system and you respect it. You cannot accept random losses from random trades made without a plan. Those are not healthy losses. Those are wastes. A healthy loss comes from a well-planned, well-executed trade that simply didn't work. It is calculated, it is controlled, and it is part of your risk management. It is the loss you had budgeted for when you opened the trade. Breathe. Feel the difference between chaotic loss and controlled loss, between panic and professionalism, between violating the rules and respecting them. First, protect the account, then think about profits. The stop is part of the plan, and I do not negotiate it. I accept the loss when I have followed the rules. These principles are not abstract theory. They are the difference between surviving in the market and being violently expelled. They are the reason why some traders last 20 years, while others disappear in 6 months. Survival comes first. Always. In nature, the animal that survives is not the fastest or the strongest. It is the most adaptable, the one that manages risks best, the one that doesn't put itself in situations it cannot get out of. You are that animal, adaptable, protective of your capital, respectful of risk. Risk management is not as exciting as finding the perfect trade. It doesn't give you the thrill of a huge profit, but it is what allows you to stay in the game long enough to learn, to grow, and to succeed. Protection first, profit after, always in that order. Let these concepts flow into your subconscious. Don't struggle to memorize them. Let them settle naturally, layer by layer, like sediment on the bottom of a quiet lake. Risk defined before entry. Fixed percentage. Size calculated from the stop. Technical stop never moved. Healthy losses when you respect the rules. Breathe. Relax, absorb. Survival is guaranteed when you protect before you attack. Defense before offense. Conservation before expansion. This is your second foundation, built solid upon the first. The step of survival is complete. Act 3. Emotional control. Take a deep breath. Relax even more. Now we enter the most difficult territory of trading. We aren't talking about charts. We aren't talking about strategies. We are talking about you. Because the real enemy in trading is not the market. The real enemy is you. This is a truth that many refuse to accept. It is easier to blame the market makers, bad luck, anything except oneself. But until you accept that the main battle is fought inside your mind, you will continue to lose. The market is neutral. It is not against you. It doesn't have it in for you personally. It moves according to its own dynamics, indifferent to your hopes, your fears, and your needs. You, on the other hand, are not neutral. You are loaded with emotions, and these emotions want to control you. Let's talk about the key emotions every trader must learn to recognize and manage. The first is fear. Fear is natural. It is a survival mechanism evolved over millions of years to protect you from danger. The problem is that in trading, fear often protects you from the wrong things and exposes you to worse risks. Fear makes you hesitate when you should enter a valid trade. You've done the analysis. The setup is perfect. The risk is defined. Everything says go. But fear whispers, what if you lose? What if it goes wrong? What if it's a fake signal? And so you hesitate, and the trade leaves without you. Fear makes you exit a winning trade too early. You have a small profit, and fear says, take it now before it disappears. You close the trade, and then you watch it continue to rise exactly as you had predicted. Fear made you miss 90% of the move. But fear also has an opposite face. The fear of losing leads you to not place the stop or to move it, because admitting the loss hurts too much. And so a small loss becomes catastrophic. Breathe. Recognize fear when it appears, but do not follow it. Greed is the second enemy. If fear paralyzes you, greed makes you reckless. Greed makes you see opportunities where there are none. It makes you risk too much on a single trade because, this time, it's different. It makes you hold a winning trade too long, waiting for ever greater profits, until the market reverses and takes it all away. Greed is insidious because it disguises itself as ambition. I want the maximum from this trade sounds like professionalism, but often it is just disguised greed. The disciplined trader takes their target and exits. The greedy trader moves the target higher and higher until they watch it vanish. Greed makes you increase your size beyond your risk limits. If 1% is good, 3% is 3 times better. No, 3% is 3 times the risk of ruin. Mathematical greed destroys accounts faster than anything else. Then there is FOMO, fear of missing out. The fear of missing the opportunity. This emotion is amplified by social media, where you constantly see people showing winning trades. Everyone is earning except me. And so you jump into trades that you haven't analyzed, that don't respect your rules just because you don't want to be left out. FOMO makes you chase the price. The perfect trade was at 100. Now it's at 110. Doesn't matter. I'll buy anyway. And you buy at the worst possible moment, when the move is exhausted and about to reverse. FOMO makes you trade too much. You can't stay still. Every market movement seems like an opportunity you can't miss. You open trade after trade without criteria, just to be in the game. And every trade without criteria is another chip you give away to the market. Take a deep breath. Feel these emotions. Recognize them. Don't judge them. They are human. They are normal. And then there is revenge trading. This is perhaps the most destructive. You have just closed a losing trade. You are frustrated, angry, hurt in your ego. And instead of following your plan, you immediately open another trade to get back, to recover what you lost, to prove to the market that you were right. Revenge trading is pure emotional trading. There is no analysis. There is no strategy. There is only pain seeking compensation, and the market ruthlessly punishes this behavior. The revenge trade almost always loses, and that loss fuels more anger, more need for revenge, more loss. It is a death spiral. Repeat mentally, I recognize the emotion. I do not follow it. This is the key to everything. You cannot eliminate emotions. You are human. You will feel fear, greed, FOMO, and anger. But you can learn to recognize them when they emerge and not let them drive your actions. It's like the weather. You can't control if it rains or if it's sunny. But you can choose whether to go out with an umbrella or not. Emotions are your internal weather. They come and go. You choose how to respond. When you feel fear, recognize, this is fear. It is normal. But my plan says to enter now. I follow the plan, not the fear. When you feel greed, recognize, this is greed. It wants more profit. But my target is here. I exit as planned, not as greed wants. When you feel FOMO, recognize, this is FOMO. But this trade does not respect my rules. I let it go. There will be other opportunities. When you feel anger over a loss, recognize, this is anger. I want revenge. But I stop. I close the platforms. I'll come back tomorrow. Recognizing the emotion creates a space between the stimulus and the response. In that space lives your freedom of choice. Without recognition, you are on emotional autopilot. With recognition, you regain control. Breathe. Let this concept settle deep down. Now let's talk about something that will surprise many: boredom. Trading is boring. If you are trading correctly, it is incredibly boring. And this is a good thing. New traders expect excitement. They expect adrenaline. They expect the thrill of constant risk and reward. And when they find boredom, they think they are doing something wrong. Why am I not doing anything? Why is the market so slow? I should do something. No. Boredom is a sign of professionalism. The professional trader spends most of their time waiting. Waiting for the right setup. Waiting for the right market conditions. Waiting for the risk-reward to be favorable. And this waiting is boring. Hours, days, sometimes weeks without making a trade. But this boredom is disguised discipline. It is patience at work. It is the refusal to force opportunities where they don't exist. Think of a sniper. They can stay motionless for hours, days, waiting for the perfect moment. They don't fire because they are bored. They don't fire to see what happens. They fire only when the target is perfectly aligned, when the conditions are optimal. The wait is an essential part of the job. You are that sniper. Waiting is part of your job. Most of the time you do nothing. And that's okay. In fact, it's perfect. Constant excitement in trading is a danger signal. It means you are trading too much, that you are forcing things, that you are chasing emotions instead of opportunities. It means you are about to lose money. Repeat, boredom is a sign of professionalism. Breathe these words. Boredom is a sign of professionalism. When you are bored in front of the charts because there is nothing to do, congratulate yourself. You are exercising discipline. You are protecting your capital. You are waiting for your opportunities. You don't have to always be in action to be a trader. In fact, the best traders make few trades. Selective, precise, patient. Quality over quantity. Always. If you feel the need to do something just to relieve boredom, recognize this is just a need for stimulation. It is not a trading signal. I'm closing the charts. I'm going for a walk. Waiting is part of the job. Repeat it. Waiting is part of the job. It is not wasted time. It is time invested in protecting your capital, in waiting for the right moment, in maintaining discipline. Take a deep breath. Now we come to an even deeper level. Detachment. You must detach from two things to succeed in trading. The first is the ego. The second is money itself. Do not fall in love with your positions. This is a common trap. You do an analysis. You decide the market will go in a certain direction. You open the trade. And then, even when the market proves you wrong, you can't accept it. Because admitting you were wrong hurts your ego. So you hold the losing trade, waiting for it to come back up. You add more to the position to average down. You rationalize why you will eventually be right. But you are not right. The market is right. The market is always right. Your ego whispers, you can't admit you were wrong. What will others think? What will you think of yourself? But this is the ego talking, not logic. And the ego destroys accounts. You must be able to say, I thought it would go up. It went down. I was wrong. I'm closing and moving on. Without drama. Without attachment. The market does not care about your ego, and neither should you. Every trade is an experiment. Some experiments confirm the hypothesis, others don't. A scientist doesn't fall in love with their hypotheses. They test them, collect data, and adjust or discard them. You do the same. Capital is a tool. It is not you. It is not your value as a person. It is simply the tool you work with, like a hammer for a carpenter or a scalpel for a surgeon. When you lose part of your capital, you aren't losing part of yourself. You are simply consuming the tool in the process of learning and working. This perspective is liberating. If capital is just a tool, you can make rational decisions. You can close a loss without feeling destroyed. You can avoid a risky trade without feeling cowardly. The tool serves you, not the other way around. But beware, detachment does not mean carelessness. It doesn't mean I don't care if I lose everything. It means I manage this tool rationally, without letting it define who I am. Your value is not the result. Repeat. Your value as a person, your intelligence, your competence, your human worth, is not defined by today's profit and loss. You made a perfect trade that lost. You are still competent. You made a terrible trade that won. You are not a genius. You are lucky, and luck eventually runs out. Repeat. I am not my P and L. Breathe deeply. I am not my P and L. My value is not written in that green or red number on the screen. I am the process I follow. I am the discipline I exercise. I am the rules I respect. When you separate your sense of self-worth from the immediate result, something magical happens. You become free to do the right thing. You don't have to prove anything to anyone. You don't have to win every trade to feel valid. You can simply execute your plan, trade after trade, without the emotional weight of needing to be right. This freedom is power. It is the power to close a losing trade without feeling like a failure. The power to lose 3 trades in a row and continue following the rules. The power to earn a lot and not let your ego convince you that you are invincible. Detachment from ego and money is not built in a day. It is a daily practice. Every time you feel attachment emerging, recognize it. This is ego. This is fear of losing money. But I am not these things. I am the trader who executes the plan. And slowly, trade after trade, day after day, the detachment grows. It becomes easier. It becomes natural. Recognize the emotion. Do not follow it. Boredom is a sign of professionalism. I am not my P and L. These phrases are your anchors when emotional waves try to drag you away. They are the solid rocks to cling to when everything seems chaotic. Emotional control does not mean not feeling emotions. It means feeling them fully, recognizing them clearly, and then consciously choosing not to let them control your actions. You are human. You will feel fear, greed, frustration, and euphoria. This does not make you weak. It makes you normal. What makes you strong is how you respond to these emotions. Breathe. Let these concepts flow into your subconscious, like a quiet river. Do not resist. Do not forniana. Let them settle naturally. Let them become part of your way of thinking, of your way of being. The real enemy is you. But when you become aware of this, when you learn to recognize and manage your emotions, when you accept boredom and detach from ego and the result, you stop being your own enemy. Act 4. Discipline. Take a deep breath. Relax completely. Now, let's talk about discipline. Discipline is the bridge between intentions and results, between knowing what to do and actually doing it. It is the difference between the trader who survives and the one who excels. Discipline in trading is not mysterious. It doesn't require superpowers. It simply requires doing the same thing over and over again and again and again, even when you don't feel like it, even when it feels boring, even when you think you could do better by improvising, always doing the same thing. This is the essence of discipline. Let's start with the foundation, the trading plan. Without a written trading plan, you aren't trading. You are gambling. You are improvising. You are hoping. A trading plan is not a document to be created once and forgotten. It is the constitution of your approach to the market. The trading plan must contain written rules, not thought-out rules, not more or less rules. Written, in black and white, clear, precise, unequivocal. When you read a rule, there must be no doubt about what it means. Not, I buy when the price looks strong, but I buy when the price breaks resistance with volume higher than the average of the last 20 periods and closes above it. Not, I exit when the trade is going well, but I exit when the price reaches twice the distance of my stop, or when the candle closes below the moving average. Do you see the difference? The first version leaves room for interpretation, emotion, and the convenience of the moment. The second version is mechanical. It is clear. It is executable without thinking. The plan must define everything. The entry. Exactly under which conditions you enter the market. Not just one condition, but all the conditions that must be present simultaneously. Technical setup, confirmations, timing, everything written down. The stop, where you place it, why you place it there, and how you calculate it. No ambiguity. The stop goes below the low of the previous candle, at a minimum distance of 3 ticks. The target, where you take profit, or how you manage a winning trade if you use trailing stops or partial exits. I exit at the first target when the profit is 1.5 R and move the stop to break even. I exit completely at 3 R, or if it closes below the moving average. No improvisation. Repeat. No improvisation. When you are in the middle of a trade, with money at risk, with emotions screaming, the last thing you need is to have to make decisions. The decisions have already been made. When you were calm, when you were rational, when there was no pressure. In the moment of the trade, you execute. You don't decide. You execute. Repeat mentally, I follow the plan even when it is uncomfortable. This phrase is crucial because the plan will often be uncomfortable. The plan will tell you to enter when you are afraid. It will tell you to exit when you want to hold. It will tell you to stay still when you feel like doing something. The plan does not adapt to your mood. You adapt your behavior to the plan. I follow the plan even when it is uncomfortable, even when every fiber of my being wants to do something else, even when I am sure that this time it's different, even when I have just had 3 losses and want to change my approach. The plan is the anchor. When the waves batter you, when the currents pull you, when the storm screams, the anchor holds you steady. The plan is that anchor. Imagine a pilot during takeoff. They have a checklist. Item by item, they follow it. Always. Every time. Not because they don't know what to do. They know perfectly well. But the checklist eliminates human error. It eliminates, I thought I did it. It eliminates forgetting something because you are distracted. Your checklist is your trading plan. You follow it because it works. You follow it because it eliminates chaos. You follow it because you, the emotional and irrational version of yourself, cannot be trusted in the critical moment. Breathe. Let this concept settle deeply. Now, let's talk about routine. Discipline doesn't just live in individual trades. It lives in the daily structure you build around trading. Routine is the container of discipline. You need a pre-market routine. Before you even look at a chart, before you even think about a trade, you have a sequence of actions that you always perform. Same order. Same way. Perhaps you start by checking the day's economic news. Then you look at the global markets. Then you identify key levels on your instruments. Then you review your rules. Then, and only then, do you start looking for setups. This sequence prepares your mind. It is a ritual that takes you from your normal state to the state of a trader. It is the transition between daily life and the profession. And by doing it always the same way, you build a consistent mental state. Great athletes have pre-game routines. Always the same warm-up, same exercises, same order. Not out of superstition. Because routine creates an optimal and repeatable mental state. You do the same. Your pre-market routine brings you into the right mental state to trade. Calm, focused, prepared, disciplined. And then there is the post-market routine. This is even more important than the pre-market, yet many ignore it. When the market closes, or when you have finished trading for the day, what do? You don't just close everything and disappear. You have a routine. Perhaps you review every trade of the day. Perhaps you update your journal. Perhaps you calculate your statistics. Perhaps you simply write down how you felt during the session. This routine closes the cycle. It is like a debriefing after a mission. What went well? What went wrong? What did you learn? What do you need to improve tomorrow? And crucially, you perform this review with a cool head. Not during the trade, Not immediately after a big profit or a big loss when emotions are still hot, but later when you are calm, when you can look at the data objectively. With a cool head, you see things you don't see in the moment. You see patterns in your behavior. You see where you violated the rules, even though you thought you were following them. You see the opportunities you missed out of fear and the ones you forced out of greed. The cool-headed review is where real growth happens. It is the moment when you transform experience into a lesson, error into improvement, and success into replicable knowledge. Breathe deeply. Feel the importance of routine, of structure, of repetition. And this brings us to the trading journal. The journal is not optional. It is not something that would be nice to do. It is essential. It is the single most powerful tool you have to improve as a trader. But a trading journal is not just a record of trades. It's not just bought at X, sold at Y, profit Z'd. That is an accounting log. Important, but not enough. The true trading journal captures two things that no chart can show you: what you think and what you feel. Write down what you think. Before every trade, write your analysis. Why are you entering? What are your expectations? What is your management plan? Write it down. Don't just think it. Write it. Why write? Because writing forces clarity. A vague thought in your mind might seem solid, but when you try to write it down, you discover the holes in the logic. You discover untested assumptions. You discover if you truly have a plan, or if you are just hoping. And after the trade, write what happened, but not just the result. What did the market do? Where was your analysis correct? Where was it wrong? What did you learn? Write down what you feel. This is even more important. How did you feel before the trade? Calm, anxious, overly confident. And during? Did you feel fear when the trade went against you? Did you feel the urge to exit early, to move the stop? And after the trade, how did the result influence your emotional state? Did a loss make you angry? Did a profit make you arrogant? This emotional data is gold because it pinpoints mental patterns that you repeat without realizing it. Perhaps you discover that every time you trade early in the morning, you are more impulsive. Pattern. Now you know. Now you can correct it. Perhaps you discover that after 2 winning trades, you become too confident and force the 3rd trade. Pattern. Now you know. Now you can set a rule. After 2 winners, a mandatory break. Perhaps you discover that your best trades are the ones where you waited the longest, and your worst are the ones where you felt FOMO. Pattern. Now you know. Now you can build a rule that forces you to wait. Repeat. I learn from my behaviors. Breathe these words. I learn from my behaviors. Not just from my strategies. Not just from my trades. From my behaviors. From how I react. From how I feel. From how I think. The trading journal is a mirror. It shows you who you really are as a trader, not who you think you are. And this brutal honesty is the only way to improve. You cannot fix what you don't recognize. You cannot improve what you don't measure. The journal recognizes and measures your behaviors, both good and bad, so you can amplify the former and eliminate the latter. Some traders resist the journal. It takes too much time. I remember my trades. I don't need it. These are excuses. The journal requires perhaps 10 minutes a day. 10 minutes that can save you years of repeated mistakes. And no, you do not remember your trades with accuracy. Memory is selective, emotional, and distorted. The journal is objective. The journal is like training with a video of your performance. An athlete doesn't improve just by repeating. They improve by watching the video, seeing the mistakes, correcting them, and trying again. The journal is your video. Breathe deeply. Let the importance of discipline permeate your every thought. A written trading plan. A pre-market routine to prepare you. A post-market routine to review. A journal to capture thoughts and feelings. A cool-headed review to learn. This is the structure. This is the discipline. It's not glamorous. It's not exciting. But it works. Discipline is doing the right thing when you don't feel like it. It is following the plan when it's uncomfortable. It is writing in the journal when you are tired. It is doing the review even when you've had a bad day and just want to forget. Discipline is the voluntary repetition of correct actions until they become automatic, until you no longer have to force yourself, until it becomes who you are, not just what you do. At the beginning, discipline requires effort. Every time, you must remind yourself to follow the plan. Every time, you must force yourself to write in the journal. Every time, you must resist the temptation to improvise. But then, slowly, discipline becomes a habit, and habit becomes character, and character becomes destiny. The disciplined trader was not born that way. They became that way. Trade after trade, day after day, following the plan even when it was uncomfortable, writing in the journal even when it was boring, doing the review even when it was painful, and in the end, that discipline transforms into results, not because every single trade wins, but because the sum of disciplined trades, executed according to a valid plan, produces profit in the long run. Discipline is the closest thing to a guarantee in trading. It doesn't guarantee that every trade will win, but it guarantees that you will behave optimally over time. And behaving optimally over time is the only thing that matters. Imagine two traders, same capital, same strategy, same market. One is disciplined. They always follow the plan. They write in the journal. They do reviews. The other improvises. They follow the plan when it suits them. They skip the journal. They avoid the review. In 6 months, one will have steady growth. The other will likely have blown their account. Not because the strategy doesn't work, because discipline makes the difference. Follow the plan even when it's uncomfortable. Learn from your behaviors. Always do the same thing. Breathe. Relax. Let these principles settle deep in your mind, like granite foundations. Discipline is not punishment, it is freedom. It frees you from the chaos of emotional decisions. It frees you from the anxiety of not knowing what to do. It frees you from the regret of having acted on impulse. When you have a plan and follow it with discipline, you always know what to do. There is no doubt. There is no hesitation. There is only execution. And in that certainty, in that clarity, you find peace. Even in the midst of market volatility, you are calm. Because you aren't improvising, you are executing. Let discipline become your second nature. Not something you do, but something you are. Breathe deeply. Absorb completely. The step of discipline is complete. Act 5. Professional thinking. Take a deep breath. Enter a state of even deeper calm. Now we explore how a professional trader truly thinks. Not how a beginner thinks. Not how those seeking shortcuts think, but how someone who has truly understood the nature of trading reasons. Professional thinking is different, radically different. And this difference in the way of thinking creates the difference in results. Let's start with the most important concept: process greater than result. This is not just a phrase. It is a complete paradigm shift in the way you evaluate yourself as a trader. The beginner trader only looks at the result. A winning trade equals I'm good. A losing trade equals I'm bad. A profitable day equals success. A losing day equals failure. This is superficial thinking. It is childish thinking. The professional trader looks at the process. The process has 3 components: analysis, execution, and review. Analysis means you have studied the market appropriately. You have identified a valid setup according to your rules. You have assessed the risk-reward. You have verified all your conditions. Was the analysis done well or poorly? This is what matters. Execution means you followed your plan perfectly. You entered where you were supposed to enter. You placed the stop where it was supposed to be. You managed the trade according to the rules. You didn't improvise. You didn't move the stop. You didn't yield to fear or greed. Was the execution disciplined or emotional? This is what matters. Review means that after the trade, you analyzed what happened. Did you learn something? Did you identify errors? Did you notice patterns? Was the review honest and complete? This is what matters. If all 3 of these components were done correctly, the trade is a success. Regardless of the economic outcome, repeat mentally, the result is a consequence. Breathe these words. The result is a consequence. A consequence of what? Of the process. If the process is good and repeated enough times, the result will be good. not by magic, by mathematics. Think of a restaurant. If it follows the correct process, quality ingredients, careful preparation, precise cooking, elegant presentation, it will have satisfied customers. Not every single dish will be perfect. Sometimes the oven might malfunction. Some ingredients might be less fresh. But in the long run, a good process produces good results. You are that restaurant. Your process is your recipe. If the recipe is good and you follow it, the results will come. Not immediately, not linearly, but inevitably. The trader who focuses on the process sleeps peacefully even after a loss, because they know they did everything correctly. The market simply went the other way this time. There is no anxiety. There is no regret. Only the awareness of having executed well. The trader who focuses only on the result is in constant torment. Even when they win, they wonder if they were just lucky. When they lose, they wonder if they are inadequate. It is an infinite emotional roller coaster. Process over result. Always. In every evaluation. In every moment. Breathe. Let this way of thinking install itself deeply. Now let's talk about probabilistic thinking. This is the second pillar of professional thinking. Trading is a game of probabilities, not a game of certainties. And thinking in terms of probabilities changes everything. When you think probabilistically, you understand that you are playing a series of operations, not a single event. One coin toss means little. 100 coin tosses reveal the real probability. One trade means little. 100 trades reveal if your system works. This is a liberating truth. It means you can stop obsessing over every single trade. This trade is crucial. No, it isn't. It is one of 100. It is a data point in a larger sample. Probabilistic thinking embraces variance. What is variance? It is the natural dispersion of results around the mean. Even tossing a perfect coin, you could get 5 heads in a row. It doesn't mean the coin is rigged. It just means variance. In trading, even with a system that wins 60% of the time, you could have 8 consecutive losses. It is not impossible. It isn't even unlikely if you make enough trades. It is normal variance. The trader who doesn't understand variance destroys themselves mentally. 8 consecutive losses and they think, my system doesn't work. They abandon the system. They look for another system. And the cycle begins again. The trader who understands variance sees 8 consecutive losses and thinks, variance. I continue to follow the process. The probabilities will manifest over time, and they continue. And when the winning streak arrives, they recover and prosper. Drawdowns are normal. A drawdown is a period in which your capital drops from its peak. It is not a failure. It is an inevitable statistical characteristic of any trading system. Even the best hedge funds in the world have drawdowns. Why? Because the market is probabilistic. If your system has a positive statistical edge, it will still have losing periods. This is mathematical. This is certain. The only uncertainty is when they will arrive and how long they will last. But that they will arrive, that is for sure. Repeat, a negative streak does not define my abilities. Take a deep breath. A negative streak does not define my abilities. It only defines that I am on the negative side of the probabilistic distribution right now. I will return to the mean. Always if I continue to follow the correct process. This understanding gives you incredible mental resilience. You don't collapse at the first difficulty. You don't quit after a losing week. You understand that it is all part of the probabilistic game. Imagine a casino. It knows that some players will win. It knows that some days will be negative. But it also knows that its statistical advantage, repeated over millions of plays, will make it profitable. It doesn't worry about individual losses. It focuses on the mathematical advantage. You do the same. You have a statistical advantage in your system. Some days you will lose. Some weeks you will lose. But repeat it enough times, the advantage manifests. This is confidence based on mathematics, not on hope. Probabilistic thinking allows you to take trades with serenity. You know that this specific trade might lose. It doesn't matter. It is one of many. It contributes to the data. It contributes to the manifestation of the edge in the long run. And when you lose, it isn't a personal tragedy. It is simply the expected outcome of this specific event in a probabilistic distribution. Next time it might be different, or the time after, or the one after that. But in the end, the probabilities win. Breathe. Feel the peace that comes from this understanding. Now we come to the third component of professional thinking: accumulating small edges. This is the secret that beginner traders do not understand. You aren't looking for the home run. You aren't looking for the trade that makes you rich. You are looking to accumulate small advantages repeatedly over time. An edge is a statistical advantage. Perhaps your edge is only 55%. You win 55 trades out of 100. Does that seem like little? It isn't. 55%, repeated thousands of times with appropriate risk management, builds enormous wealth. The edge doesn't have to be huge. It just has to be positive and repeatable. Professional thinking seeks few good trades, not hundreds of mediocre trades. Few trades that perfectly respect the criteria. High probability trades. Trades where everything aligns. Quality over quantity. Always. Trading too much dilutes your edge. Every trade that doesn't perfectly respect your criteria lowers your win rate. It is better to make 5 excellent trades a month than 50 mediocre trades. And these few good trades, some must be well managed. Managed means calculated risk, appropriate stop, logical target, no improvisation during the trade, and exiting according to the plan. A trade can be a perfect setup, but if you manage it poorly, moving the stop, exiting out of fear, holding too long out of greed, you lose the edge. Management is just as crucial as identification. Think of a professional poker player. They don't play every hand. Fold, 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 fold. They wait. Then they see a premium hand. They enter. They manage the hand perfectly. They maximize the value. Then they go back to folding. They aren't trying to win every pot. They're trying to accumulate small advantages when the probabilities are in their favor. And these small advantages, accumulated over thousands of hands, become a consistent income. You do the same. In the long run, these small accumulated edges become your career. Not the single fantastic trade, not the stroke of luck, the constant, boring, disciplined accumulation of small advantages. The long run is the key. This phrase appears constantly in professional thinking. In the long run. Because the short run is chaos. It is variance. It is noise. The short run can show anything. But the long run reveals the truth. The long run separates luck from competence. The long run rewards the correct process and punishes the wrong one. The professional trader always thinks in the long run. Not, how can I make money today? But how can I build a process that makes me profitable over the next 5 years? Not, will this trade make me rich? But does this trade contribute positively to my long-term statistics? It is a shift in temporal perspective, from the immediate to the lasting, from the urgent to the important. Breathe deeply. Feel this stretching of your temporal perspective. From the anxiety of the moment to the calm of the long vision. Process over result. Probabilistic thinking that embraces variance and drawdown. Accumulation of small edges in the long run. This is how a solid trader reasons. It is not emotional. It is not instinctive. It is not based on hopes. It is rational, mathematical, and procedural. The result of a single trade does not touch them. A negative streak does not scare them. A period of drawdown does not make them doubt, because they know they are playing a different game. Not the game of the immediate result, the game of the correct process repeated over time. And this game, mathematically, they win. When you judge yourself as a trader, don't ask, did I win today? Ask, did I follow my process today? If the answer is yes, you won. The economic result is just a consequence that will manifest over time. When you face a losing streak, don't ask, why am I losing? Ask, am I still correctly following my process? If yes, then it is just variance. Continue. If no, correct the process. When you make a trade, don't ask, how much can I earn? Ask, does this trade have a positive edge, and am I managing it correctly? If yes, it is a good trade regardless of the result. This way of thinking makes you indestructible because you are not at the mercy of results. You are anchored to the process, and the process is under your control. The market can do whatever it wants. It can go up, down, sideways. It can be volatile or calm. It can reward you today and punish you tomorrow. You do not control the market, but you control your process. And by controlling the process indirectly in the long run, you control the results. This is the magic of professional thinking. It transforms the uncontrollable into the controllable. Not by controlling the market, but by controlling yourself. Let these concepts settle into your subconscious as fundamental truths. You don't have to repeat them consciously. Let them become part of your way of seeing trading, part of your identity as a trader. The result is a consequence. A negative streak does not define my abilities. A few good trades, well managed, in the long run. Breathe. Relax completely. Absorb this wisdom. Professional thinking is not built in a day. It is built trade after trade, decision after decision, by repeatedly choosing to focus on the process instead of the result, to think probabilistically instead of deterministically, to play the long game instead of seeking quick wins. But when this way of thinking becomes your nature, when you no longer have to force yourself to think this way because you naturally think this way, then you have become a solid trader. Not perfect, not infallible, but solid, resilient, professional. And solid traders survive. And by surviving long enough, with the correct process, they prosper. Breathe deeply. Let go of every tension. The step of professional thinking is complete. Act 6. Essential Technique. Take a deep breath. Enter an even more complete state of relaxation. Now let's talk about technique, but not about complexity, about simplicity. Because essential technique is that which works, not that which impresses. Only what truly serves you. This is the philosophy. Trading does not require hundreds of indicators. It does not require complicated strategies. It does not require exotic setups. It requires a few essential elements, deeply understood and consistently applied. Let's start with the structure of a strategy. Every solid strategy, any solid strategy, has 4 fundamental components: market, time frame, hours, and rules. The market is where you trade. You cannot trade everything. You must choose forex, stocks, indices, commodities, cryptocurrencies. Choose 1 or 2 markets and become an expert in those. Learn their peculiarities, their rhythms, and their characteristics. Every market moves differently. Gold reacts to economic news in one way, EUR/USD in another, tech stocks in yet another. Knowing your market intimately gives you an advantage. You become sensitive to its nuances. The time frame is the time interval you use to make decisions. 5-minute chart, hourly, daily, weekly. There is no best time frame. There is the time frame that fits your style, your available time, and your personality. But once chosen, stay there. Do not jump from one time frame to another looking for confirmation. This is called cherry picking, and it destroys the statistical consistency of your system. Choose your primary time frame and respect it. The hours define when you trade. Not all hours are equal. Sometimes have more volume, more volatility, and more opportunities. Others are dead, with minimal movement. Identify the optimal hours for your market and time frame, and trade only during those. Perhaps you only trade the first 2 hours after the open. Perhaps only during the overlap of sessions. Perhaps you avoid lunch hours completely. Whatever your choice, define it and respect it. Trading outside your defined hours is improvisation. And then there are the rules. Rules are everything. They are the precise conditions that must be present to open a trade. Not vague. Not interpretable. Precise. If A and B and C, then I enter. Otherwise, no. Defined market, defined time frame, defined hours, defined rules. This is the structure. This is the foundation upon which you build everything. Breathe. Let this structure install itself in your mind. Now we come to a crucial concept. Context before pattern. This is the difference between a superficial trader and a profound one. The superficial trader sees a pattern and enters. The profound trader first evaluates the context, then looks for the pattern. Context is the general market situation. Where are we? In what kind of environment? What is the prevailing direction? This determines which trades make sense and which do not. The first element of context is the trend. Is the market going up, down, moving sideways? This is the fundamental question. And the answer determines your bias. In an uptrend, you look for buying opportunities. Buying patterns have a higher probability of working. Selling patterns are against the current and riskier. In a downtrend, you look for selling opportunities. Selling patterns have a higher probability of working. Buying patterns go against the flow. In a range, the market oscillates between support and resistance. Here, you buy at support and sell at resistance, or you wait for a breakout to follow the new direction. Range is the second component of context. Where is the price moving? Between which levels? How wide is this range? A narrow range suggests compression and a possible explosion. A wide range suggests instability or consolidation. Key levels are the third component. These are important supports and resistances, recent highs and lows, and areas of historical price reaction. These levels act as magnets or barriers for the price. A buying pattern near strong support makes sense. The same pattern in the middle of nowhere makes less sense. A selling pattern near strong resistance makes sense. In the middle of the range, it is less significant. Repeat mentally. First the context, then the signal. Breathe these words. First the context, then the signal. Not the other way around. You don't look for patterns everywhere and then justify the entry. First, you evaluate the context. Then you look for patterns that are consistent with that context. This approach drastically increases the quality of your trades. You eliminate low probability trades. You enter only when everything aligns, favorable context, and valid pattern. Imagine a hunter. They don't shoot randomly into the forest. First, they identify where the prey is, context. Then they wait for the right moment to shoot, pattern. Context first, then action. Take a deep breath. Let this way of thinking become natural. Now let's talk about core patterns. There are thousands of patterns in trading, but you only need a few fundamental patterns, understood deeply. 4 main patterns cover most situations. The first is the hammer. A candle with a small body at the top and a long lower shadow. What does it tell you? That the price fell during the period. Sellers pushed down. But then buyers stepped in with force and brought the price back up, closing near the highs. The hammer is a signal of bearish rejection. The market tried to go down, but it couldn't make it. When it appears after a drop or near support, it suggests a possible bullish reversal. But beware, the hammer alone is not a signal. It is a suggestion. It must be in the right context, at the right level, with confirmation in the subsequent period. The second pattern is the engulfing, 2 candles. The second candle completely swallows the first. A bullish engulfing has a bearish candle, followed by a bullish candle that covers the entire range of the first. A bearish engulfing is the opposite. The engulfing shows a change in strength. First, a movement in one direction, then a stronger movement in the other that completely overcomes it. It is a change in sentiment, a transfer of power between buyers and sellers. Again, context is everything. A bullish engulfing at a key support after a drop has meaning. In the middle of nowhere, it has little value. The third is the shooting star, the opposite of the hammer. Small body at the bottom, long upper shadow. The price went up. Buyers pushed it up. But then sellers stepped in and brought the price back down. Shooting star is a bullish rejection. The market tried to go up, but it was repelled. Near resistance or after a rally, it suggests a possible bearish reversal. The fourth set of patterns are the morning star and evening star. 3 candle configurations that show a reversal. Morning star, a bearish candle, a small indecision candle, and a strong bullish candle. It shows the transition from bearish control to uncertainty to bullish control, a reversal from the bottom. Evening star, a bullish candle, a small indecision candle, and a strong bearish candle. It shows the transition from bullish control to uncertainty to bearish control, a reversal from the top. These patterns show the process of reversal. It is not instantaneous. There is a phase of battle, of indecision, and then the new direction prevails. 4 patterns: hammer, engulfing, shooting star, morning, evening star. These cover most reversal and continuation situations. You don't need 100 patterns. You need to know these 4 deeply. To know them deeply means recognizing them instantly, understanding the psychology behind them, knowing when they work best, when to ignore them, and how to combine them with context. Breathe. Mentally visualize these patterns. Let them become familiar. Now let's talk about support and resistance. These are the levels where the price has historically reacted. But many traders misunderstand them completely. Support and resistance are not precise lines. They are zones. Price does not magically respect a level to the cent. It oscillates around an area. So don't think support is exactly at 1.2500. Think there is a support zone between 1.2480 and 1.2520. This understanding changes everything. You don't wait for an exact price. You wait for the price to enter the zone and then look for reactions. Zones are more realistic. They allow for the natural variability of the market. They eliminate the frustration of seeing the price stop at 1.2505 when your support was at 1.2500. How do you identify these zones? From a price reactions, where the price has historically slowed down, bounced or reversed. Not from a magic formula. From the price history itself. If you see that the price has touched an area 3 times in recent months and bounced every time, that is a significant zone. If the price passed through a level without even slowing down, it is not significant. Price reactions are the truth, not arbitrarily drawn levels, not round numbers just because. The zones where the price has actually shown historical respect. Support and resistance are zones, not lines. Identified by price reactions, not formulas. Take a deep breath. Feel the simplicity of this approach. Finally, let's talk about position management. This is where many traders lose the profits they earned with the entry. You have 3 main tools: partial exits, break-even, and trailing stops. Partial exits mean closing part of the position at certain levels, while holding the rest for further targets. Perhaps you close half the position at the first target of 1R or 2R, protecting the profit. You hold the other half for 3R, 5R or more. This gives you the best of both worlds. You take guaranteed profit with the partials, but maintain exposure to larger movements with the rest. Break-even means moving your stop loss to the entry point once the trade has reached a certain profit. Perhaps when you are at +1R, you move the stop to break even. Now the trade can no longer lose you money. In the worst case scenario, you exit at 0. This eliminates anxiety. You know that at the very least you won't lose. You can let the trade develop without the fear of seeing a profit disappear into a loss. The trailing stop is a stop that moves with the price in your favor, but does not move back. If the price goes up, the stop goes up with it, at a certain distance. If the price goes down, the stop stays where it is. Trailing allows you to capture large movements without having to guess where the move will end. You let the market tell you when it's finished by closing you out with the trailing stop. These 3 techniques, used together or separately depending on the strategy, allow you to maximize profits without increasing risk. They protect what you have earned while leaving room for greater gains. Position management is the art of transforming a good entry into a great trade. Many traders only focus on the entry. How do I get in? But the exit is just as important. How you manage the trade determines how much profit you extract. Partials to guarantee profit. Break even to eliminate risk. Trailing to capture large moves. These are the tools. Use them wisely. Breathe. Feel the completeness of this essential technique. Strategy structure, market, time frame, hours, rules. Context before pattern, trend, range, levels. Core patterns, hammer, engulfing, shooting star, morning, evening star. Support and resistance as reaction zones. Management with partials, break-even trailing. This is all that is truly needed. It is not little, but it is not too much. It is essential. It is sufficient. It is time-tested. The temptation will be to add. What if I tried this indicator? What if I added this other pattern? What if I complicated it a bit? Resist. Complexity does not improve results. It often makes them worse. Mastery does not come from accumulating techniques. It comes from deepening essential techniques. Better to know 4 patterns deeply than 40 superficially. Better to completely master a simple strategy than to continuously switch from one complex strategy to another. Simplicity is power. Simplicity is clarity. Simplicity is executable under pressure. When you are in the moment of the trade, with money at risk, with emotions pressing, you need simplicity, not complexity. You need to know exactly what to look for, what to do, and when to do it. And this clarity comes from essential technique. Only what truly serves you. Let these technical elements settle into your subconscious, not as formulas to be memorized mechanically, but as profound understandings that become intuitive. Over time, you will look at a chart and recognize instantly bullish context, support zone, perfect hammer. You won't have to think about it. You will see it. You will feel it. This is technical mastery, not impressive complexity. Simplicity perfectly executed. Take a deep breath. Relax completely. The step of essential technique is complete. Act 7. Hypnotic Glossary. Take a deep breath. Enter an even deeper state of relaxation. Now, we move through the language of trading, word by word, concept by concept, repeated. Always the same, always simple. Let these definitions flow into your mind like calm water. Do not struggle to memorize. Let them settle naturally. Trend. The trend is the prevailing direction of the market over a given period of time. The market moves in waves, but beneath those waves, there is a current. That current is the trend. A bullish trend means the market is rising over time. Higher highs, higher lows. Each wave rises higher than the previous one. The current moves upward. A bearish trend means the market is falling over time. Lower highs, lower lows. Each wave falls lower than the previous one. The current moves downward. The trend is your friend. This is one of the oldest truths in trading. Trading in the direction of the trend increases your probabilities. The trend has momentum. It has strength. Going against the trend is possible, but riskier. Trend, prevailing direction, bullish or bearish. The current beneath the waves. Breathe. Let it settle. Support. Support is a level or a zone where the price has historically found buying interest, where buyers step in, where the price tends to stop or bounce instead of continuing to fall. Imagine the price as a falling ball. Support is the floor. When the ball touches the floor, it bounces. Not always. Sometimes the floor breaks, but often it bounces. Support works because traders remember. They remember that at that level, the price bounced before. So when the price approaches again, they buy. And these purchases create upward pressure. Support. The more times a support holds, the more significant it becomes. But beware, when a support breaks, it often breaks violently. Everyone who is buying there now sells. The floor becomes a ceiling. Support. Zone of buying interest, where the price tends to stop or bounce. The floor. Breathe. Let it settle. Resistance. Resistance is the opposite of support. It is a level or a zone where the price has historically found selling pressure, where sellers step in, where the price tends to stop or reverse instead of continuing to rise. The rising ball finds a ceiling. Resistance. When it touches the ceiling, it is pushed back down. Not always. Sometimes the ceiling breaks, but often it is repelled. Resistance works for the same reason as support. Collective memory. Traders remember that at that level, the price was rejected before. So, when the price approaches again, they sell. Downward pressure. Resistance. When a resistance breaks and the price moves beyond it, that resistance often becomes support. The ceiling becomes the floor. Sellers become buyers. This is called a role reversal. Resistance. Zone of selling pressure, where the price tends to stop or reverse. The ceiling. Breathe. Let it settle. Volatility. Volatility is the measure of how much the price moves, how much it varies, how much it oscillates. High volatility means large movements. Low volatility means small movements. Imagine the sea. Sometimes it is calm. Small waves. Gentle movements. Low volatility. Other times it is stormy. Huge waves. Violent movements. High volatility. Volatility is neither good nor bad. It is simply a characteristic. High volatility offers more profit opportunities, but also more risk. Low volatility offers fewer opportunities, but more stability. As a trader, you must adapt to volatility. In high volatility, wider stops, smaller positions. In low volatility, reduced profit expectations, increased patience. Volatility. Measure of price movement. How much it varies. The waves of the sea can be calm or stormy. Breathe. Let it settle. Market order. A market order is an order to buy or sell immediately at the current market price, whatever that price may be. You don't specify the price. You just say buy now or sell now. The advantage of the market order is the certainty of execution. You will be executed, almost always, immediately. You don't risk missing the opportunity because you are waiting for a specific price. The disadvantage is slippage. You might not get exactly the price you see on the screen, especially in fast or liquid markets. Execution is guaranteed, but the exact price is not. Market order. Execute now at the current price. Certainty of execution, uncertainty of exact price. Limit order. A limit order is an order to buy or sell at a specific price or better. You specify, I only buy if the price drops to this level, or I only sell if the price rises to this level. The advantage of the limit order is price control. You know exactly at what price you will be executed if you are executed. No surprises, no slippage. The disadvantage is the uncertainty of execution. You might not be executed at all. The price might not reach your level. Control over the price, but no certainty of entering the trade. Limit order. Execute only at this price, or better. Price control. Uncertainty of execution. Breathe. Let it settle. Stop loss. A stop loss is an order that automatically closes your position when the price reaches a certain level against you. It is your safety net, your protection, your parachute. When you enter a trade, you define, if the price goes against me to this point, I get out. I accept the loss and move on. This is the stop loss. The stop loss protects you from catastrophic losses. It transforms potential disasters into controlled losses. It is the difference between losing 2% and losing 50%. Never trade without a stop loss. Never. Even if you think the trade is safe. Even if you are watching it. Never. The stop loss is non-negotiable. Stop loss. An order that closes the position at a predefined level of loss. Your protection. Non-negotiable. Take profit. Take profit is the opposite of stop loss. It is an order that automatically closes your position when the price reaches a certain level in your favor. Your target. Your profit objective. When you enter a trade, you define, if the price goes in my favor to this point, I get out. I take the profit and close. This is the take profit. The take profit helps you not to be greedy. It helps you take profits instead of always waiting for more until the profit disappears. It gives you discipline in your winning exits. Some traders always use fixed take profits. Others prefer to manage manually or with trailing stops. Both approaches work if applied with discipline. Take profit. An order that closes the position at a predefined level of profit. Your target. Discipline in exiting. Breathe. Let it settle. Risk-reward. Risk-reward is the ratio between how much you risk and how much you can potentially earn on a trade. If you risk 100 euros to potentially earn 200 euros, your risk reward is 1 to 2. Written as 1 to 2. A good risk reward means the potential gain is greater than the risk. At least 1 to 2. Better if 1 to 3 or more. This means that even by winning only 50% of your trades, you are profitable. Risk reward is fundamental in selecting trades. A trade with a 1-to-1 risk reward requires at least a 50% win rate to be profitable. A trade with 1 to 3 requires only 25%. Simple math. Never take trades with a negative risk reward. If you risk more than you can earn, you are playing a losing game. The math is against you. Risk reward. Ratio between risk and potential gain. At least 1 to 2. Fundamental for long-term profitability. Breathe. Let it settle. Breakout. A breakout is when the price breaks beyond a significant level of support or resistance. It exits the zone where it was contained. It breaks the ceiling or the floor. A bullish breakout is when the price exceeds a resistance. It breaks upward, often followed by a strong movement in the new direction because many traders were waiting for that break to enter. A bearish breakout is when the price breaks below a support. It breaks downward, often followed by acceleration because stop losses are hit and add pressure. Not all breakouts are real. Some are false breakouts. The price breaks, then immediately turns back. A trap. Therefore, breakouts must be confirmed, not blindly chased. Breakout. Breaking of a significant level. Bullish above resistance. Bearish below support. Requires confirmation. Pullback. A pullback is a temporary movement against the main trend. A pause. A correction. The market rises, then pulls back a little, then resumes its rise. That pulling back is the pullback. Pullbacks are opportunities. They allow you to enter an ongoing trend at a better price. Instead of chasing the rising price, you wait for the pullback and enter when the price temporarily moves back. In a bullish trend, pullbacks are downward movements. Buying opportunities. In a bearish trend, pullbacks are upward movements. Selling opportunities. The secret is distinguishing a healthy pullback from a trend reversal. The pullback returns to the trend. The reversal changes the trend. Experience and context help to distinguish. Pullback. Temporary movement against the trend. Opportunity to enter the trend at a better price. A pause, not a reversal. Breathe. Let it settle. Range. A range is a period where the price moves sideways between a support and a resistance without a clear direction. Oscillation. Back and forth. Up and down, but without net progress. The range has an upper limit, the resistance, and a lower limit, the support. The price bounces between these two limits, like a ball in a box. In a range, the strategy changes. You don't follow the trend, because there is no trend. You buy at support and sell at resistance. Or you wait for the breakout from the range to follow the new direction. Many markets spend most of their time in a range. They are only occasionally trending. Recognizing when you are in a range prevents you from forcing trend trades that won't work. Range, sideways movement between support and resistance. No clear direction. Contained oscillation. Strategy different from trending. Breathe. Let it settle. Liquidity. Liquidity is the ability to buy or sell quickly without significantly affecting the price. Liquid markets have many participants, many orders, and fluid movements. High liquidity means you can enter and exit easily. Your orders are executed quickly. The bid-ask spread is tight. Little difference between the buying and selling price. Low liquidity means gaps in prices, wide spreads, and execution difficulties. Your orders can move the price. You enter at one price and exit at another very different one, even for small movements. As a trader, you prefer liquid markets, especially for short-term trades. Liquidity gives you control and predictability. Illiquidity creates hidden costs and execution risks. Liquidity, ability to buy or sell easily. Many participants, fluid execution, tight spreads. Fundamental for trading. Breathe deeply. Let it settle completely. Now, let all these terms merge together in your understanding. Not as separate words, but as parts of a coherent language. The language of the market. Trend, support, resistance, volatility, market and limit, stop loss and take profit, risk reward, breakout and pullback, range, liquidity. Each term is a piece of the puzzle. Together, they form the complete image. When you look at a chart, you see all these elements operating simultaneously. You see the trend. You identify supports and resistances. You evaluate volatility. You decide how to enter, market or limit. You place stop loss and take profit. You calculate the risk reward. You recognize breakouts or pullbacks. You determine if you are in a range or trending. You consider liquidity. All together. Not separate, integrated. And with repetition, these terms become second nature. You don't have to think, what is a support? You see it and recognize it instantly. You don't have to remember. How do you calculate risk reward? You calculate it automatically. This is the familiarity you are building. Word by word. Concept by concept. Repetition after repetition. The glossary is not to be memorized mechanically. It is to be absorbed organically. Let the definitions flow into your mind now, while you are relaxed. Your subconscious absorbs them. It organizes them. It integrates them. When you wake up, you will not consciously remember every definition word for word. But when you see a chart, when you hear these terms, you will recognize them. You will understand them. You will use them naturally. This is subconscious learning, not forced. Fluid, natural, trend, prevailing direction, support, the floor, resistance, the ceiling, volatility, The magnitude of movement. Mark it. Now at the current price. Limit. Only at this price. Stop loss. Protection from disaster. Take profit. Discipline and profit. Risk reward. How much risk for how much gain? Breakout. Breaking of the containment. Pullback. Pause in the trend. Range. Sideways movement. Liquidity. Ease of execution. Repeat mentally. Do not struggle. Let it flow. These terms are your linguistic tools. With them, you communicate with other traders. With them, you think about the market. With them, you build strategies and plans. Without this vocabulary, you are mute in the world of trading. With this vocabulary, you can express, understand, and analyze. And the beauty is that they are not complex. They are simple, direct, practical. Each term describes an observable reality in the market, not abstract theory, concrete reality. Breathe deeply. Feel the clarity of these definitions. When you feel lost in trading, return to these fundamentals. Return to the glossary. Remember what these terms truly mean, not the complications that others add to them. The essential meanings. The trend is simply the direction. Support is simply where buyers step in. Resistance is where sellers step in. Volatility is how much it moves, and so on. Simplicity, clarity, foundations. Let this hypnotic glossary settle deeply into your subconscious, not as data to be retrieved on demand, but as intuitive understanding that emerges when needed. Relax completely. Breathe. Absorb. The step of the hypnotic glossary is complete. Act 8. Stories. Take a deep breath. Enter a state of relaxed listening. Now, let's talk through stories. Because the brain does not remember lists. It does not remember abstract rules. It remembers stories. It remembers narratives. It remembers people and their choices. The stories you are about to hear are simple, short, but they carry profound truths. Let them flow into your mind. Do not judge them. Do not analyze them. Simply listen to them. Your subconscious will extract the lessons. The first story is about Marco. Marco moves his stop. Marco has been a trader for 6 months. He has studied. He has a plan. He knows the rules. This morning he sees a perfect setup. Uptrend. Pull back to a key support. A hammer candle that confirms it. Everything aligns. Marco enters the trade. He buys at 100. His plan says to put the stop at 96. 4 points of risk. The target is at 108. 8 points of potential profit. A 2-to-1 risk reward. Perfect. Marco places the stop at 96. He breathes. He follows the plan. The price rises. 101. 102. Marco smiles. Then the price slows down. It goes back to 101. 100. 99. Marco begins to feel tension. 98. The price is approaching his stop. And then Marco makes the choice that will change everything. He thinks, it's just a temporary shakeout. The setup was perfect. I don't want to be stopped out only to see the price rise without me. And he moves the stop from 96 to 93. The price continues to fall. 97. 96. He should have been out. 95. 93. Stop hit. Marco exits with a 7-point loss instead of 4. But it's not over. The price falls further. 90. 85. Marco watches paralyzed. His perfect setup has collapsed. And instead of losing 4 points as planned, he lost 7. 75% more. And worse, he has destroyed his confidence in the plan. Now he doubts. Maybe I should have moved the stop even lower. Maybe the plan doesn't work. But the plan worked. It was Marco who didn't work. Marco learned the most painful lesson. The stop is never moved. Never. No matter how sure you are, no matter how unfair it seems, the stop is sacred. Breathe. Let Marco's story settle. The second story is about Sarah. Sarah enters out of FOMO. Sarah is a prudent trader. Usually. She follows her rules. She waits for her setups. But today is different. Today, everyone on social media is talking about this stock. It has gone up 20% in 2 days, 30% in a week. The charts show enormous green candles. Everyone is making money. Sarah watches. Her system gives no signal. There is no setup. There is no pullback. The price has already exploded. But the FOMO grows. Everyone is making money. I'm missing the opportunity of a lifetime. I have to get in. Sarah looks for justifications. The trend is strong. The volume is high. I'll only enter with a small position. But she knows she is lying to herself. There is no setup. It's just FOMO. She enters. The price is at 150. No plan. No clear stop. No defined target. Just the hope that it keeps going up. The first day, it rises further. 155. Sarah feels justified. See, I was right. But she wasn't right. She was lucky. The second day, the price opens at 158. Sarah is euphoric. Then, without warning, it starts to fall. 150, 140, 130. In a few hours, she loses 15%. Sarah is paralyzed. She has no stop. She has no plan. She holds. It will come back up. It has to come back up. But it doesn't. 120. 110. Finally, in a panic, she sells at 110. A loss of 27%. The next day, she reads the news. The company announced disappointing results. Informed traders were getting out. Sarah had entered exactly when they were exiting. She had bought at the top, driven by FOMO, not by strategy. Sarah learned FOMO is not a strategy. It is a destructive emotion. The best trades are the ones you don't chase. They are the ones you wait for. Breathe. Let Sarah's story settle. The third story is about Luca. Luca respects the plan. Luca has been a trader for 3 years. He has seen Marco move stops. He has seen Sarah chase out of FOMO. He has made those mistakes himself years ago. Now it's different. This morning, Luca sees a setup. Not perfect, not exceptional. Simply solid, a downtrend in a stock, pull back to a resistance. An evening star pattern. Confirmation from his system. Luca enters short at 80. His plan says stop at 83. Target at 72. Risk reward about 3 to 1. Not exciting, just math. The price falls. 79. 78. 77. Luca feels no excitement. It's just another trade. Then the price bounces. 79. 80. 81. Luca feels the temptation. Should I move the stop? Maybe it's just normal volatility. But he stops. He remembers Marco. He remembers his rules. The stop is at 83. If it is hit, I accept the loss and move on. The price rises further. 82. Luca breathes. Almost at the stop. That's fine. It's part of the plan. 83. Stop hit. Luca is out. A loss of 3 points. Exactly as planned. No drama. No emotion. Only execution of the plan. Luca closes the chart. He writes in his journal, Trade number 203. Valid setup according to the rules. Stop hit. Controlled loss. No execution errors. And he goes on with his day. The price, it rises to 86 before crashing to 70. But Luca doesn't know. And he doesn't care. Because looking back at closed trades is useless. The trade is over. What matters is that he followed the plan. That week, Luca makes 5 trades, 2 win, 3 lose. But the 2 winners have a 3 to 1 risk reward. The 3 losses are controlled at 1 to 1. Net result, positive, not spectacular, consistent. Luca understood. Discipline beats talent. Respecting the plan beats being good at analysis. Consistency beats sporadic, exceptional performances. Breathe. Let Luca's story settle. 3 stories. 3 traders. 3 choices. 3 results. Marco moved his stop. He lost more than expected. He lost confidence in the plan. He learned the lesson the hard way. Sarah gave in to FOMO. She chased. She bought at the top. She lost heavily. She learned that emotions are not strategies. Luca respected the plan. He accepted the controlled loss. He maintained discipline. He continued to build his career trade after trade. You are not Marco. You are not Sarah. You are Luca. Or you are becoming Luca. Choice by choice. Trade by trade. Take a deep breath. Now let me talk to you about archetypes. About great traders who represent universal principles. Warren Buffett represents patience. Buffett is not a trader in the classic sense. He is an investor. But the principle is universal. Patience wins. Buffett waits, years if necessary. He doesn't chase. He doesn't panic. He waits for opportunities to come to him, and when they arrive, when the price is right, when the value is clear, he acts decisively, significantly, but the rest of the time, he waits. He reads. He thinks. He does nothing. And in that doing nothing, there is supreme discipline. For the trader, this means do not force. Do not trade out of boredom. Do not chase every move. Wait for your setup. Wait for your conditions. Patience is not passivity. It is active discipline. Buffett says, the market is a device for transferring money from the impatient to the patient. Let this truth resonate. The impatient lose. The patient accumulate. Breathe. Feel the calm of patience. Jim Simons represents the system. Simons created one of the most profitable funds in history through algorithmic trading. Pure mathematics, statistics, system. Simons did not trust intuition. He did not trust feelings. He trusted data. He trusted mathematics repeated over millions of trades. A tiny statistical advantage repeated infinite times, compounded over time. For the trader, this means build a system, test it, measure it, then execute it without emotion. Do not modify it every day. Do not doubt after a losing streak. Trust the statistical process. Simons proves that mechanical consistency beats sporadic genius. The simple system followed perfectly beats the brilliant strategy followed inconsistently. You don't have to be a mathematician, but you can adopt the principle: system over intuition, process over feeling, statistics over hope. Breathe. Feel the clarity of the system. Buffett and Simons. Patience and system. Two archetypes. Two universal principles. Patience in selecting opportunities. System in executing them. You can integrate both. Buffett's patience in waiting for the right setups. Simon's system in executing them perfectly. You don't have to choose. Take the best of both. The stories you have heard are not random. They are archetypes. Marco represents every trader who violated their rules and paid the price. Sarah represents every trader who gave in to the emotion of the moment. Luca represents every trader who chose discipline over impulse. Buffett represents the power of waiting. Simons represents the power of the system. You will carry these stories with you. When you are tempted to move your stop, you will remember Marco. When you feel FOMO, you will remember Sarah. When you have to choose between impulse and the plan, you will remember Luca. When you are impatient, you will remember Buffett. When you want to improvise, you will remember Simons. Stories live in memory better than rules. The brain is made for narratives. Use this nature. Let these stories become your internal guardians. Not, I must follow the plan, but what would Luca do? Not, I must not give in to FOMO, but I remember what happened to Sarah. Stories transform abstract rules into concrete reality, into people, into choices, into consequences. And when you create your own story, day after day, trade after trade, you decide. Will you be Marco or Luca? Sarah or the patient trader? Impulsive or systematic? Your story is being written now. With every decision, with every trade, with every moment in which you choose between emotion and the plan, between impulse and discipline, between immediate need and the long-term goal. Write a story you will be proud of. A story of discipline, of growth, of learning from failures, of celebrating correct processes, not just lucky results. Take a deep breath. Let these narratives intertwine with your understanding of trading. Marco, Sarah, Luca, Buffett, Simons. Living archetypes of eternal principles. Relax completely. Absorb the lessons not as rules, but as lived stories. The step of stories is complete. Act 9. Identity. Take a deep breath. Enter the deepest state of relaxation of this entire journey. This is the last step, the most important one, because now we are not talking about what you do. We are talking about who you are, your identity as a trader. Actions follow identity. If you believe you are a certain person, you will act consistently with that identity. If you see yourself as disciplined, you will act with discipline. If you see yourself as respectful of risk, you will respect risk. Identity precedes behavior. Let's begin with identity affirmations. These are not empty slogans. They are declarations of who you are choosing to be. Repeat them mentally. Let them flow. Not as hopes, but as truths you are building. I am disciplined. Repeat mentally. I am disciplined. Not I want to be disciplined. Not I'm trying to be disciplined. I am disciplined. Present tense. Definitive. What does it mean to be disciplined as a trader? It means you follow the plan even when it's uncomfortable. It means rules come before emotions. It means routine is sacred. It means consistency beats inspiration. I am disciplined. When I see a setup that doesn't respect my rules, even if it looks promising, I do not enter. Because I am disciplined. When a trade goes against me and the stop approaches, I do not move it. Because I am disciplined. When I feel like skipping the daily review, I do it anyway. Because I am disciplined. Discipline is not something I do occasionally. It is who I am. It is my identity. When people think of me as a trader, they think, disciplined. Breathe. Feel this identity forming. I respect risk. Repeat. I respect risk. I don't ignore it. I don't minimize it. I don't defy it. I respect it. What does it mean to respect risk? It means I calculate it before every trade. It means I always use a fixed percentage of my capital. It means the stop loss is not optional. It means protection comes before profit. I respect risk. The market is bigger than me, stronger than me. It can wipe out my account if I don't pay attention. So, I pay attention. Always. Every single trade. I don't convince myself that this time is different. I don't tell myself that this trade is safe. I don't delude myself into thinking I can afford to risk more. Risk deserves respect, and I give it. Respecting risk is not cowardice. It is wisdom. It is professionalism. It is the difference between surviving and disappearing. I respect risk. This is my identity. Breathe. Let it settle. I accept the loss. Repeat. I accept the loss. I don't fear it. I don't avoid it. I don't deny it. I accept it. What does it mean to accept the loss? It means I understand that losses are an inevitable part of trading. It means I don't define myself by a single loss or a series of losses. It means I can close a trade in the red without feeling like a failure. I accept the loss. When I have followed my plan perfectly and the trade lost, I can say, I did my job. The market went the other way. That's fine. Next trade. I don't hold a grudge against the market. I don't seek revenge. I don't despair. I accept. It happened. I lost. Next. Acceptance of loss frees me from paralyzing fear. I can enter a trade knowing it might lose, and that's okay. Because I know that in the long run, by following the process, I will be profitable. I accept the loss, not as resignation, but as mathematical realism, as emotional maturity. This is my identity. Take a deep breath. Feel these 3 affirmations becoming part of you. I am disciplined. I respect risk. I accept the loss. And these are not future aspirations. They are present declarations. From today. From this moment. Even if you don't embody them perfectly yet, by declaring the identity, you begin to grow toward it. The brain seeks consistency. If you see yourself as disciplined, the brain will push you to act in a disciplined way to be consistent with your identity. If you see yourself as respectful of risk, it will be easier to calculate risk because that's what I do. That's who I am. Identity is the deepest level of change. You don't just change behaviors on the surface. You change who you are at the core. And from that depth, the right behaviors emerge naturally. Breathe. Let these identities take deep root. Now let's talk about the long-term vision. Because who you are as a trader is not defined in a day. It is defined in years, in a career, in a marathon. Trading is a marathon, not a sprint. This analogy is powerful. In a sprint, only speed matters. Maximum intensity, short duration, all or nothing. But trading is not like that. Trading requires a sustainable pace, conserved energy, consistency over time, like a marathon runner. The marathoner doesn't run at maximum speed. they would run for a mile and collapse. Instead, they find their pace. They maintain it. Mile after mile. Hour after hour. Not the fastest pace possible. The sustainable pace. You are that marathoner. You aren't looking for the perfect trade that makes you rich tomorrow. You are looking for the sustainable process that keeps you profitable for years, decades. You don't burn all your capital in a month of aggressive trading. You build slowly, constantly, protectively, step by step, trade by trade, month after month. The marathon requires patience. It requires ignoring those who pass you by running. It requires trusting your rhythm even when it seems slow. It requires continuing when you are tired, when it hurts, when you want to stop. But who finishes the marathon? Not the one who started the fastest, the one who maintained the pace, the one who managed their energy, the one who endured. Breathe. Feel the sustainable rhythm of the marathon. Trading is measured in years, not in days, not in weeks. Years. This temporal perspective changes everything. If you think in days, I must earn today. This trade must work. This week must be positive. Pressure, anxiety, rush decisions. If you think in years, today is just one day of thousands. This trade is one of hundreds. This week is one of 52 in a year, of hundreds in my career. Calm, perspective, thoughtful decisions. Thinking in years means a losing week doesn't destroy you. It's just variance in a larger sample. It means a fantastic month doesn't make you arrogant. It's just a good period in a long distribution. Thinking in years means you invest time in learning, knowing that the benefits will manifest slowly. It means you accept drawdowns because you know that over the years they will smooth out. It means you build. You don't destroy and rebuild continuously. Great traders think in decades. Failing traders think in days. Where do you want to be in 5 years? In 10? This is the question that guides you. Not, how much can I make this month? Take a deep breath. Stretch your temporal perspective. Feel how this reduces anxiety and increases calm. And the key to the marathon of years is consistency. Not occasional brilliance, daily consistency. Consistency means doing the same right things repeatedly. Pre-market routine. Execution according to the plan. Post-market review. Journaling. Every day. Not when you feel like it. Every day. Consistency means not changing your system every month. Choose a valid approach. Give it time. Hundreds of trades. Months. Years. Let the statistics manifest. Consistency means managing risk the same way. Always. Not 2% today, 5 tomorrow, 1 after. Always the same, always disciplined. Consistency is boring. It's not exciting. It doesn't make for Instagram stories. But it builds careers. It builds accounts. It builds confidence. Drop by drop, stone by stone, trade by trade, year after year. This is the consistency that wins. Repeat the final, most powerful phrase. Every day I build the trader I want to become. Breathe these words. Every day I build the trader I want to become. You are not the perfect trader yet. No one is. But every day you have the chance to build, to improve, to get closer to the version of yourself you want to be. Every time you follow the plan, when you don't feel like it, you build discipline. Every time you calculate risk before entering, you build respect for risk. Every time you accept a loss with grace, you build emotional maturity. Every day, choice after choice, action after action, build. It's not about being perfect today. It's about being slightly better than yesterday. 1% better. A small step forward. Repeated every day for years. This is the mathematics of compound growth. Not just in capital, in competence, in discipline, in identity. Who you are today plus small daily improvements times years equals the extraordinary trader you will become. Breathe. Visualize this future trader. Disciplined, respectful of risk, accepting of losses, patient, systematic, consistent, profitable, not by luck, but by process. That trader is you. Not tomorrow. Not in 5 years. Now. Because you are building now. Every trade executed according to the plan is a brick. Every emotion recognized and managed is a brick. Every honest review is a brick. Every day of consistency is a brick. Brick by brick, you build the edifice of your trading career. And the beauty is that you don't have to build fast. You have to build solidly. Deep foundations, robust structure, patience in the process. Skyscrapers are not built in a month. They require years. But when they are finished, they last for decades, centuries. Your trading career is that skyscraper. Build it well. Build it solid. Build it with patience. I am disciplined. I respect risk. I accept the loss. Marathon. Years. Consistency. Every day I build the trader I want to become. These are the foundations of your trader identity. Not techniques. Not strategies. Identity. Who you are when you sit in front of the charts. Who you are when the market challenges you. Who you are when no one is watching. Identity is not static. It evolves. It grows. It strengthens. Every day you live consistently with it, it becomes deeper, truer, more natural. In the beginning, you will have to remind yourself, I am disciplined. I must act with discipline. But over time, you won't have to remind yourself. You will act with discipline automatically because it is simply who you are. Identity becomes automatic. It becomes your nature. And when you reach that point, trading becomes much simpler. You no longer fight against yourself. You are aligned. Take a deep breath. This journey through 9 acts is about to conclude. But the real journey, your journey as a trader, continues. Every day, every trade, every choice. You have traveled from mental reset through survival, emotional control, discipline, professional thinking, essential technique, glossary, stories, up to identity. Each act is built upon the previous one. Each lesson connects to the others. Together they form a complete understanding of what it means to be a solid trader. But remember, knowledge is not enough. Application is everything. You must live these principles. You must embody this identity. You must walk this marathon step by step. It won't be easy. There will be difficult days. There will be losses that hurt. There will be moments of doubt. But you have the tools. You have the understanding. You have the identity. You are disciplined. You respect risk. You accept the loss. You think long term. You are consistent. Every day you build the trader you want to become. This is not fantasy. This is your reality that you are creating. Choice after choice. Day after day. And when 5 years, 10 years from now, you look back, you will see the path. You will see the growth. You will see how these principles, absorbed while you slept, while you relaxed, became the foundation of your successful career. Trading has changed you, not just as a trader, as a person. More disciplined, more patient, more resilient, more aware, more in control. And it all started here, with the mental reset, with the acceptance of uncertainty, with the respect for risk, with the choice of discipline, with the identity of who you want to be. Take a deep breath. Once, twice, 3 times. Let everything you have heard settle completely into your subconscious. You don't need to consciously remember every word. Your subconscious has absorbed it. It has organized it. It has integrated it. When you wake up, when you open your eyes, you will not be the same person. You will be the trader who has taken the first step of the marathon. The trader who has chosen the identity of discipline, respect, and acceptance. And from that first step, 1,000 other steps will be born. 1,000 trades, 1,000 days of building, until you no longer have to build consciously. You will simply be the trader you have become. Relax completely, breathe, absorb, integrate. Every day I build the trader I want to become. I am disciplined. I respect risk. I accept the loss. Marathon. Years. Consistency. This is my journey. This is who I am. This is who I am becoming. Breathe. The journey through the 9 acts is complete. But your journey begins now.